Right, good morning and welcome to the Calculus Capital webinar, Life After the Budget, in relation to EIS and VCT investments. Please note that this call is being recorded and is intended for IFAs, clients and guests of Calculus Capital. Any opinions expressed during this webinar do not constitute tax or investment advice. If you are not an IFA or direct or potential client of Calculus Capital, please hang up now. For anyone with questions during or following the presentation, please use the box on the right-hand side of the screen. Today's host is John Glencross, CEO of Calculus Capital. John has over 30 years' experience in private equity, corporate finance and operational management. He co-created and launched the UK's first approved EIS fund in 1999 with Susan MacDonald, Calculus Capital's chairman. He is a board member of EISA and sits on their tax and technical committee, as well as a member of the EU State Aid Committee. For those of you not familiar with Calculus Capital, we are a multi-award-winning firm specialising in tax-advantaged investment funds. I will now pass you over to your host, John Glencross.
Good morning, and thank you for joining us this morning. Life after the budget. I think it is worth spending some time this morning just discussing the changes. The changes are quite significant. There's a significant realignment of EIS and VCT rules, and I think it's useful to understand the thinking behind the changes and then also understand the direction of travel that the Treasury wants to see in these schemes going forward. A very quick recap on EIS and VCTs. As I'm sure many of you know, EIS has raised over 16 billion since it was introduced in 1994, and over 26,000 companies have received EIS investment. VCT significant as well, 7 billion invested since launch, and every chancellor since Kenneth Clarke, who introduced it, has supported the schemes, but obviously, of course, they are currently subject to EU state aid control. And for those who don't know, and I'm sure everybody does, EIS and VCT investment is intended to provide growth capital to promising companies, promising predominantly UK companies, by offering generous tax breaks. And it has to be said that these schemes, notwithstanding whatever else has been happening, or the rule changes now, these schemes have been of fundamental importance in the support of growing UK companies. Background to the budget. The background to the budget is really the patient capital review, and I'm sure many of you will be aware of the consultation, the patient capital review consultation. In September 2016, the Treasury launched the patient capital review. The initial reason for doing it was to look at the reasons why there seemed to be a shortage of scale-up capital in the UK, and figures came out from the OECD that showed that we were third amongst the advanced nations for startups in terms of successfully funding startups, but I think 13th of the advanced nations in our ability to provide scale-up capital to companies. And that was something that was concerning the Treasury, that companies were not having access to the capital that they needed to grow, and a particular concern to the Treasury that they were being acquired too early, being lost essentially to the UK by acquisition, often by larger American companies. In February, the Treasury decided to add into the patient capital review to look at the so-called tax-advantaged investment schemes, EIS, VCTs, SITR, and obviously SEIS, about whether they provided value for money. No government consultation process may start with one objective, but it never ends up with one objective. And also, it was asked to look at the reasons for the declining rate of UK productivity growth compared to the rest of the advanced world, and also whether there might be other ways of providing venture capital, development capital to promising companies other than by means of the tax advantage schemes. And the Treasury actually did a cost comparison to them, or to the UK government, of the various schemes, and actually you can argue, everybody's argued about the basis of the comparisons, but it showed that venture capital support, development capital coming from the British Business Bank was the cheapest, EIS was next, SEIS was more expensive, obviously because of the higher tax reliefs, and then VCTs they had as the most expensive. I think in their calculation they had something like, for every £1 invested it cost the Treasury £1.20, which I'm not sure about. I know the basis. I think that was I think that was a little excessive in their calculations. They set up an advisory panel led by Damon Buffini, who many of you may be aware of, who was formerly head of Permira, the big private equity house. I think what came out in particular in relation to the tax advantage schemes, EIS and VCT, was the Treasury's concerns about how much of the investment was being used. They were concerned in particular about the amount of funds flowing into so-called low-risk capital preservation investments. They had some concerns about some aspects of film finance and whether that really was true capital at risk. And also, interestingly, and this came home to me particularly in a conversation I had with the Treasury after the consultation process closed, but prior to the formulation of their proposals for the budget, when I went with four big successful entrepreneurs who've all actually had successful companies and are now what you might call super business angels. So because the Treasury wanted to talk about, want to hear from actually the entrepreneurs, the people who've done it, the people who have benefited from EIS and subsequently built, or VCTs and subsequently built substantial companies. They wanted to hear their views. And one of the things that came out in the conversation was the Treasury's unhappiness with some of the investment strategies and behaviour of VCTs, and that was something that really only became apparent it's quite late in the day, and it's interesting. We'll talk more about that a little later, because there were changes in the budget which do affect the way that VCTs invest. Now, one of the things that the Treasury is unhappy about is that they have looked, and I think we should all be aware, they are very aware of what's happening out there in the investment scene. And of course, they get all the information on EIS and VCTs from HMRC. So, and they actually as well, they read the documentation of offers and fundraisings and firms, the prospectuses for various offerings. They are very aware of what's going on out there in the market, as it were. Their estimate is that half to two-thirds of EIS funds deployed, particularly by so-called EIS funds, represented lower risk investment. And what they mean by that is investments, capital preservation schemes, investments that have asset backing primarily underpinning the value. The capital's not really at risk, and in fact the return amounts to basically the income tax benefit over the holding period of the investment, three years or so. And they felt that those are not really within the spirit of the legislation in terms of what you might call capital at risk. They also had an issue with film finance. Not all film investment. I mean, this is one of the challenges they had, because What they were concerned about is what they saw as essentially tax relief being given for investment, which was really just bridge financing. For example, if you have a production that's pre-sold to something like 75% of its production costs by sale to certain major customers, and you just need 25% to cover the outstanding portion, they felt that was not where equity risk capital should be going under the EIS scheme, and it really is just bridge finance and should be capable of being financed as such. And but obviously the challenge for them is they're aware that we are very strong on the creative industries, and they didn't want to hit what you might call creative investment in creative companies. I mean, the reason that James Bond is made here is because we are so good at special effects, and that's because small companies have developed very, very good technology for that. And so, I mean, in terms of that, they were fed up with what they described as the whack-a-mole syndrome, and what they meant was they stopped investment in solar because they felt that wasn't really equity capital at risk. Then came anaerobic digestion, so they stopped that. Then came, say, self-storage, and something which is not that big, but seemed to become almost like a sort of poster thing in terms of their eyes, in terms of the not really being capital at risk, was crematoria. There are not that many crematoria, but it got a certain amount of disproportionate attention in terms of whether that was investment in crematoria, EIS and VCT investment, was truly capital at risk. And underpinning all this is something that was described to me by a former cabinet minister as be aware, remember, this government particularly wants to define itself as being supporting those just about managing, and anything that appeared to smack of tax relief for the affluent is something that they are very, very sensitive about. And apparently 2 cabinet ministers did make the point to the Treasury that there was too much abuse in these schemes, and they should look at whether they were continued at all. So that shows you just quite, how serious it might have been. And if you do a survey, and I think one was done of MPs, sadly not that many know about EIS or VCTs, but those that do tend to regard them as more about tax relief for the affluent rather than about what they do, which is seriously support promising UK companies. So the Treasury also had some specific concerns about how VCTs invest. And one of the things they felt was that VCTs were sitting on too much cash, raising too much, and not investing fast enough. And we have seen recently, last couple of years, some very big fundraisings, 40, 50, 60, 100 million. And they felt that they weren't investing fast enough. That they were sitting on too much cash. And then there's another point which became apparent, and this is quite a subtle point, but you can show just how much the Treasury is watching what's going on. Until November 2015, most VCT investment, not all, but most VCT investment was in smaller MBOs. And historically, VCTs had achieved higher returns with lower volatility from MBO type investing than they had from their so-called growth investing, where returns were actually lower if you analyze the portfolios, and the volatility was higher. So in November 2015, if you remember, the rules were changed and VCTs could no longer invest in MBOs. But then VCTs had a challenge about how do they try to achieve the same levels of returns whilst no longer being able to do MBO investing, for which they were set up, but growth investing. And what came out of that was a number of VCTs about what you might call quite aggressive investment terms. Most VCT investments are a combination of equity and debt, and the equity had quite large, quite sort of heavy requirements in terms of so-called liquidity preferences, who got their funds out first, and then extremely high coupons, 20-25% on the debt, and the Treasury said, but you're getting your capital, you're getting your return regardless of how the company is performing by basically these preferential rights and high coupon rates, and that's not what we intended. We wanted to see greater alignment with entrepreneurs. So that was something that affected VCT, the issue of VCT investment, and which the Treasury is reflected in the changes. What actually came out Wednesday? Well, effectively, we have the end of capital preservation schemes. And it's the end of whack-a-mole. That they whack the mole one place and it comes up somewhere else. They whack solar, it comes up as anaerobic digestion. What they've gone to is a new principles-based approach. There's a focus now. They want to see these schemes focused on entrepreneurial growth companies, but also within the rules there were particular measures to try and stimulate investment in the so-called knowledge-intensive companies, innovative technology and science-led companies. There were changes to the way that VCTs have to invest going forward, and actually I read one of the well-known commentators saying that they were something like minor changes to the way VCTs invest. Actually, I think really fundamentally they are rather more significant, because I think they are quite a marked change for VCTs in terms of investment strategy going forward. And as you're probably aware, there were no changes to the tax reliefs, no change to the minimum holding period, no change to business property relief, though there was actually an interesting comment in the documentation surrounding the budget that the government is looking at business property relief as to whether too much is going into low-risk investment, because obviously originally that whole scheme was intended, the BPR scheme was intended to cover family companies that they didn't have to split up or be broken up at the time of generational change. And also there were some interesting proposals, not changes at the moment, interesting proposals with regard to pensions. In terms of the crackdown, I think it probably is, it's a good term, the crackdown on capital preservation schemes. We're going to go, the rules are going to go to a so-called principles-based approach designed to identify if investments are lower risk and therefore not qualifying. That's going to apply from royal assent for the finance bill, which is probably going to be, I don't know, sometime like May next year. But actually, they've announced that HMRC will only give advanced assurance from early December based on the new rules, not the old rules. Now, what that probably means for capital preservation schemes, that if it's already got preliminary advanced assurance and it's out there raising money, it is actually okay until the finance bill receives royal assent. But any new scheme being launched now, even if it's technically okay under the rules for the moment, is not going to get advanced assurance. So, I think effectively this really means the end of capital preservation from now, although there are some schemes I know out there still trying to raise money. There's an interesting point that I was discussing with a big wealth manager yesterday about, the Treasury is clearly unhappy about these schemes and whether they're talking about anti-abuse legislation in various parts of their discussion papers. And I mean, there is the possibility, and it's only the possibility, and this is my thought, not nothing official, that they could look at some of the capital preservation schemes that are out there in the same way they looked at film finance partnerships, about whether they really were ever intended to be proper commercial businesses. Because as I understand it, the attack subsequently on film partnerships was that they were never intended to be commercial businesses, and therefore they were schemes just designed to achieve the tax breaks. What is the principles-based approach? It's, does the company have objectives to grow and develop in the longer term? Is there a significant risk of loss of capital to the investor greater than the net cost of their investment? Is there asset backing? Obviously, it is part of that. Does the income tax relief really constitute the return? And is the company focused on a longer-term growth strategy? And those are the principles that essentially are going to be applied in the future. And in early December, the HMRC is going to come out with more guidance on that. But really, if you think about most of the capital preservation schemes that we have seen, if you apply those rules about long-term growth and development of the company, significant risk to capital greater than the net return to the net of tax cost, significant asset backing, you can see that a lot of those capital preservation schemes are not going to be qualifying going forward. And there is a fundamental change to the playing field for EIS and VCTs to focus it on entrepreneurial companies with, as I said, also a particular sort of stimulus for so-called knowledge intensive. And that is a very significant change if you think about the amount that was going into those sorts of schemes historically. The focus now is about entrepreneurial growth-orientated companies, but also there were particular measures in the budget for so-called knowledge-intensive companies, which are the science-led companies, the technology-led companies, the R&D heavy companies. And there were some specific changes relating to those. The annual investment limit for EIS investors was increased from 1 to 2 million, provided that second million is invested in so-called knowledge-intensive companies, and there is a particular set of criteria to identify knowledge-intensive companies. As I said, basically the level of R&D, the nature of their employees, etc. I mean, it has to be said, we actually have some £1 million investors, not many, but if you ask me how many people does that affect, I would say probably about 200 in the company, and really it's the big heavyweight business angels who are likely to be impacted by that. The annual investment limit for those knowledge-intensive companies is increased from 5 million to 10 million, which is really trying to also address this issue about lack of scale-up capital. It has the lifetime cap on how much a company can raise under these schemes, though, hasn't changed, and for knowledge-intensive companies it's 20 million. So really, I mean, there's a limited, it's helpful, but actually it only goes so far, because if there's a 20 million cap, you basically can only likely do one 10 million round. And also a lot of companies, don't necessarily want to raise 10 million in the early stages because of the dilution. And then there's some greater flexibility about the timescales for knowledge-intensive companies. That they have to have raised tax advantage money within the first 10 years, and there's some changes to how you measure that 10 years. I mean, one of the things, if you think about everything I've said, the so-called principles-based approach, etc., and those sort of criteria. Is much of this going forward will depend on the interpretations that HMRC places on things like the interpretation of the principles. And I mean, the DNA of HMRC is to collect tax. The intention of the Treasury is to stimulate funds flowing into promising UK companies. They don't necessarily always coincide. And I actually had a conversation with the Treasury on the afternoon after the budget and discussing that, and they said they were well aware of that, and they're mindful to ensure that HMRC, in its approach and its interpretations, is reasonable and sensible. But the focus going forward is on entrepreneurial companies, and as I said, effectively, it's the end of capital preservation. For VCTs, as I said, I think the changes are quite fundamental, and I think when you're looking at VCTs, this is something to bear in mind. There's the removal of grandfathering. Some older VCTs could still invest in things that later VCTs couldn't because they were grandfathered. That's all gone. Everybody's now investing off the same, the same rules. VCTs have to invest 80% of their funds now, not 70%, into qualifying companies. So they want to see more VCT money put to work. And interestingly, going forward, and these will be from the 6th of April 2018, VCTs have to invest 30% of the funds raised in any year within 12 months. And actually, this is going to be potentially quite a challenge for people who are raising very large amounts of money. That they've now got to be seen to input 30% of it to work quickly. This is from the 6th of April, not at the moment, and that what we're likely to see is frequent smaller fundraisers going forward, rather than the very large fundraisings we've been seeing at the moment. And if you think that VCTs are already sitting on cash, they have had some exits, they've raised a lot already. If they do big fundraisings going forward, there's quite a challenge about putting all that to work within the timescales. But the Treasury really, as I said, wants to see money put to work faster. And then there were some changes to the terms under which VCTs can invest. As I said, the Treasury was unhappy that VCTs appear to be trying to get their return sort of regardless of the performance of the underlying company by very aggressive, very high interest rate levels on the debt portion of any investment. And what they've said is they will look at these and apply anti-abuse legislation. Quite interesting to see this sort of language coming into talking about EIS and VCTs. Anti-abuse legislation, but as they say, but for any debt, any investment by a VCT in a company, provided it is unsecured, and most were secured previously, provided it's unsecured, and provided that the interest rate is under 10%, that's then there is a so-called safe harbor, and they're not going to look at it. I.e., what they're saying is, in future it's unsecured, and in future it has to be below 10%. And I mean that's what that means is that VCTs, which were already many VCTs, not all. I mean some were growth VCTs. I have to say, ours is. Some were already doing that painful change from being MBO investors to growth investors, and those are different disciplines. Now, some of the things that they were trying to use in order to achieve the same returns while adjusting to a different type of investing have been taken away. There's going to have to be greater alignment between the entrepreneur and the company and the investor. And what that probably means is that we're likely to see more volatility in the returns achieved by VCTs in their investments going forward, because it's going to be growth investing on normal terms. And it was interesting that a comment came out from the AIC, which, on behalf of VCTs, which said, just after the budget, which said we need to consult our members. The obesity industry faces significant challenges in complying with these rules, and that's that's not all VCTs, but it is many VCTs, and actually some of the larger ones. Some VCTs are growth VCTs, and these issues aren't really going to impact them. There were some other interesting things came out of the budget, just to deal with them quite quickly. To address this issue about lack of scale-up capital, the government's going to set up a scale-up fund under the auspices of the British Business Bank. It's going to start it off with £2.5 billion. And then the intention is it raises outside capital and IPOs once it's got momentum. So that's really to address this issue about scale-up. VCT and EIS is really that whole period that the company goes through to get to needing so-called scale-up capital, which we're talking about like 20 plus million. They said they are considering some changes to the pensions legislation to change or amend the annual and lifetime caps, provided the additional funds are invested in so-called patient capital. And then they're consulting with the big pension funds and big investment institutions about relaxing the rules to enable them to be able to invest in less liquid assets such as venture capital and patient capital. But those are all things that are under consideration or in further consultation, primarily to address the issue, which is where the patient capital review actually started, which was the actual, it's a true fact, a lack of scale-up capital for UK companies. What does this mean for investors? Well, it means that investors will be unable to invest in capital preservation schemes. That's challenging, obviously, for funds that was what they specialized in. For EIS funds and for VCTs that were focused on growth investing, they've actually been given an endorsement by the Treasury in the changes. Growth portfolios can be more volatile. I think going forward, what we'll need to see is a sensible diversification in a portfolio of growth investments, with a number of different drivers behind those companies. For example, healthcare has one set of drivers, leisure has a different set of drivers, so it's to see sensible diversification in portfolios. Probably within portfolios, more detailed winners and losers, hence all the greater need for portfolio diversification. And I think the fundamental point is that investors probably need to be aware, investors who were used to investing in capital preservation, that that this is different, but actually, it done properly, it can achieve sensible returns. As I said, the rules now are focused on growth companies. There are particular incentives for science and technology in order to stimulate those, but clearly, those science and technology R&D-led companies can have a different risk-return profile. VCTs are having to have a painful adjustment to life in terms of being growth investors, and now having to meet quite sort of firmer, stricter targets for how fast they invest their funds. And the whole direction of travel that the Treasury wants to see, and they are making this very clear, is that they are unhappy about a lot of what has happened in the past in terms of EIS and VCT investment, and they want to see it. They are supportive, but they want to see them applied according to what they regard as the spirit of the legislation. So there has been a fundamental change to the playing field. I'm very happy to try to answer questions, and to the extent that we can't do it this morning, we are here, and if you want to ask us separately in some way, give us a call. We're very happy to do that. But thank you.
Thank you, John. As a reminder for those of you that would like to ask questions, please use the box on the right-hand side of your screen. Nobody else can see your questions apart from us, and we will not name who is asking the questions either. John, we have our first question in. How is the investment strategy likely to change in light of PCR's impact on what can be included in portfolios, excluding capital preservation and encouraging knowledge-intensive holdings?
Gosh, I think, growth investing is a very different activity from capital preservation. I think it's going to be very hard for those who've been capital preservation investors to suddenly say we're growth investors. I think for those who are doing growth investment, life is largely carrying on. I think we have to wait to see how the HMRC applies some of the so-called principles in this principle-based test about what is what amounts to capital preservation, low risk, and what is truly in the spirit of the legislation. So I think investors need to be aware that if they are investing in EIS and VCTs, it's growth investment, and it has a different profile. But I think that those growth investment portfolios need to have reasonable number. I mean, single company investing is a little bit high risk. I think you need to have a sensible portfolio in terms of number of companies in a fund. I know a lot of funds do 4 or something like that. I mean, I think that's quite narrow. And I think ideally you want to have you want to have different drivers behind those companies. Because in different sectors of the economy they are driven by different things. Healthcare is, we're getting older, we're getting more demanding for healthcare, but we're not getting healthier. Other things are actually more economically based. I mean, it has to be said that if you look at the way that opportunities have changed over the cycle, we are seeing a lot more that is technology enabled and science driven, not necessarily disruptive technologies, but technology enabled. Now, those may or may not qualify as knowledge intensive. Knowledge intensive is really, to an extent, quite at the sharp end in terms of its risk-return profile. I think it has a place, but I think it has a place within an overall portfolio.
Thank you. Any comment on how the investment strategy is likely to change in light of latest OBR report and Brexit?
The OBR report. Well, this is, I think underlying a lot of what the Treasury is trying to do here is coming back to something that's been much discussed this week and certainly was mentioned in the actual budget, which is our poor performance in terms of productivity. Our rate of growth is declining and we are noticeably doing worse than other advanced countries. And I think the feeling is that the more we can invest in technology and the more we can invest in science, the more that will help to improve our productivity performance. And certainly, the emphasis in the budget, the particular measures for the so-called knowledge intensive, is intended to try and address that. I mean, it's been a sticky problem for decades. So whether it does, but I mean, the answer may well lie in greater investment in technology and technology-enabled businesses and also in science. So that, I think, is, in terms of the one thing we're likely to see. The other question was, what was it? Sorry, what the other part was?
The latest OBR report and Brexit.
Well, Brexit is interesting. I mean, we're still subject to EU state aid regulation. That, I think, is why the lifetime cap on how much companies can raise hasn't gone up. I mean, who knows on Brexit when it's going to be. We're probably about 3 years away from being truly free of EU regulation. I think those people who think that somehow we're going to revert back to a much more, looser investment situation for these rules is probably being a little naive. I think the Treasury has signalled what it wants to see from them. So I think there can be some there will be some changes once we're out of the EU. I don't think there's going to be a fundamental change again into these. In the way these schemes operate, or a fundamental realignment. I think the Treasury, regardless of whether we're in the EU or not, is expressing very clearly what it wants to see from these schemes, and that's likely to be the direction of travel going forward.
Okay, can you explain why deal flow cannot happen more quickly than 12 to 18 months? This is a concern for many clients, given the size of the playing field.
Yes, well, I think it's an interesting point. Number of factors. I think an investment takes about 4 to 5 months to do, and the reasons for that are because of things like formal due diligence, financial due diligence, legal, commercial, people due diligence, documentation. Also, you've got the process of, at the moment, of advance assurance. And advance assurance for an investment is anything around 12 weeks. But that can't start until you're quite into the process, because you have to make that application with the documentation already done. So it's not as if you can do it the moment you have an agreement to work towards making an investment. So individual investments take quite a time. And as I said, if you want sensible portfolio diversification, it takes time. I think if you think about growth investing and how it differs from so-called low-risk capital preservation, because you are likely to get greater volatility in terms of the performance of individual companies in a portfolio, you actually need to have reasonable diversification within a portfolio. Now, I agree with you, 18 months is quite long, and actually I can say that I can see for us that it's coming down below that. We do need HMRC has undertaken to reduce the advance assurance process quite significantly. We'll see. I mean, they're not having any more resources, so we'll see on that. But really, if you want sensible portfolio diversification, and you want thorough investments, with proper due diligence, proper documentation, proper warranties from companies, it takes time. Put all that together, and it's hard to come in with a sensibly put together portfolio in under 12 months.
Thank you, John. And can you give us some comments as to whether Calculus are in good shape to avoid these new rules and general crackdown going forward? The investments so far in a portfolio seem to entirely fit the spirit of the EIS rules.
I think we are pretty well. I think we've always been investors within the spirit of the legislation. And some people have regarded that as a bit naive, but we've always been investors within the spirit of the legislation, and it's for that reason that actually, we have quite good relations with the Treasury and people like that, and why after the consultation process was over, they invited us in to talk to them and bring in some entrepreneurs, because they wanted to hear from entrepreneurs about, who are operating at the sharp end. So I think we've always been in the spirit of the legislation, and we'll wait to see how the principles are applied by HMRC. As I said, Treasury is aware that HMRC can sometimes be a little overzealous. But I would see that actually, what we do has had an endorsement rather than any sort of curtailment or negative impact. So I was actually pleasantly surprised after the budget, because there have been some sort of suggestions it was going to be far more severe for the whole schemes. So I think we're in good shape, and we're seeing good deal flow, and we've got a very active pipeline, and we've grown our team to both in terms of our investment team and our investor relations team to handle the activity that we're seeing.
Thank you, John. We have 2 more questions and then we'll wrap it up, but we can take further questions from everybody online if anybody would like to get in touch with the Investor Relations team or with John directly. So the second to last question, the decision to increase the annual limit from 5 million to 10 million but retain the lifetime limit is 20 million. It seems inherently contradictory if the intention is to improve UK's ranking for provision of scale-up capital.
Yes, there is an inherent contradiction, and I think the issue is that the Treasury has the powers at the moment to increase the annual limit to 10 million, but that the 20 million cap was something that was negotiated on a very sort of tough basis with the EU, and is very much part of EU state aid regulations. So for as long as the state aid regulations apply, that's likely to stay in place. The Treasury, I've spoken to the Treasury about this, they accept that actually there is a case for raising that, but they can't at the moment. So yes, I'm afraid we get this inherently contradictory situation where what they've done is helpful in the provision of scale-up capital, but it only can go so far because of these other issues. So for the moment, that's the best that can be done. Perhaps, and it's not going to be for some time, when we're out of EU regulatory control, that there can be further adjustments on this. But I think to change that at the moment, they've got to go back to the EU to negotiate.
Thank you, John. And finally, John, how likely, in your view, is HMRC Treasury likely to attack existing capital preservation EIS?
Well, this is just my view. This is nothing more than my view. I think it's probably a possibility rather than a probability. It was interesting that they started talking about using anti-abuse legislation to look at some things within the EIS and VCT activity. I would feel that for most capital preservation schemes historically it's fine. The only basis on which I could see that they could retrospectively attack is the same basis that they seem to use for some film finance partnerships, where they attacked them, and I think won, that they were never set up to be profitable commercial businesses. Whether a business achieves profitability and commercial success is one thing, but what they said was that they felt those were never actually set up with those intentions, and therefore were merely structures to achieve to benefit from the tax break. So that's the only basis I could see they could apply. I think it's a possibility, not a probability historically. It's not the Treasury; it would be HMRC. I think that that's an HMRC activity, and what they would see as anti-abuse legislation. Could happen. That's my view only, not official policy. I think it's probably okay, but I think that the Treasury wants everybody to get the message. It's different now, and I think even if schemes are open, capital preservation schemes now, and have had advance assurance, you're probably okay. But it's if you want be aware that the Treasury is signalling its unhappiness with these things, and actually, for the significant wealth managers, to an extent, be aware that the Treasury is far more aware of who's doing what and what's going on out there than perhaps we all might have thought.
Great, thank you very much, John. Ladies and gentlemen, this concludes our webinar today. If you do have any further questions, please feel free to reach out to a member of the Calculus IR team. The information is up on the screen. If you do have any further questions, we are available. And thank you very much for your time. Bye-bye.
Okay.